Our next guest is taking on fair disclosure rules, calling them unfair to investors and casting blame for some of the downside volatility seen in the markets this year. He's John Levin, CEO of Levin Capital Strategies, and he's here at Post 9 to explain. Welcome to you. You think companies should be able to talk more and forget all these rules and quiet periods. Why?
It's a complicated subject, and I recognize not the merit, but why the other side is saying what they're saying. Let me take the background. When Arthur Levin put this in, I've been arguing about this for 20 years, that big mutual funds, big investors were getting preference, so the idea was to make it fair for everybody and the public. But that concept is completely wrong. The public cannot make investment decisions, in my opinion, in competition with professional analysts.
Let's use the example of Armstrong World Tile. We're talking about a tile company, right?
Yeah. Well,
what happened in that case?
Well, in any case, if you wanted to talk to them, the stock was down very sharply, but they wouldn't talk to you until the earnings were reported.
But that's meant to be fair. That's why
that is meant to be fair.
But
if you just even if you had a sense of what the basic business trends were, you didn't have to have quantification. It really falls in two categories, Kelly. One, there are a lot of questions that somebody wants to know that affect a year or two off and have nothing to do with earnings. So you might want to ask any company, there's a new competitor coming in.
Sure.
What will be the impact in Armstrong of a new competitor? A European company has announced a new plant. It's a 1 or 2 year. IBM has currency. You want to find out, IBM's hedged short run, but they won't talk to you. What is the 1 year impact when their currency hedges run off?
Right.
Supreme Court makes a decision that coal plants are going to be on for a while. That's not this quarter, but none of the companies will talk to you about the range of things that are 1, 2, 3 years off.
And we should mention, by the way, we as a show would love this if companies could come out and address some of these issues and not fall into quiet periods.
Well, actually, the press is explicitly excluded from FD because of the First Amendment, so they can always talk to us.
I actually think, Mike, that's a great point.
They frequently don't anyway.
Yeah, exactly.
Mike, that's a great point. I'm actually a member of the bar, Yale Law School, loved it. I think it's abridgment of free speech, the whole thing. So,
well, here's the thing, though. So every company, though, faces this decision. Is anything going on that's material to our business that we have to disclose based on what the market is seeing out there? I mean, they have the freedom, if they wanted to pre-announce the quarter or come out and say something big is going on.
But that's the other side of the coin. The question is, they have used this reg and expanded it not to say anything about things that have nothing to do with this quarter. So the first change I would make would be to say that questions that relate not to this quarter are fair game. Then the question of this quarter is, can you give qualitative sense without quantitative, which I think will be our business conditions generally the same.
But does that require any action on the part of the SEC? Does that require any reform of the fair disclosure regs? Or is that just changing company practice?
That is 100% correct. It's not in the regs, it's in the interpretation. But I think Larry Fink and I think Warren Buffett, there are big forces trying to have no earnings forecasts and even less disclosure.
Move the other way, exactly.
And what I think is that there's got to be some industry group that rebalances it, is all I'm saying. Your point is correct.
Yeah.
It's not codified, it's not reg, it's practice.